Let me tell you what the headlines got wrong about Fort Knox and the Federal Reserve's gold holdings. The headline version is that the U.S. holds over 8,000 tons of gold. It has been audited, everything is fine, and anyone who questions it is a conspiracy theorist who does not understand how institutional auditing works. Here is the reality. The last comprehensive independent audit of U.S. gold reserves, one conducted by a third party with full physical access to count, assay, and verify each bar, has not happened in a way that would satisfy the evidentiary standards any serious institutional investor would require for any other asset of comparable value. What has happened is a series of internal government audits using procedures and documentation standards that would not be accepted for a publicly traded company. And the gap between the audit that has happened and the audit that should happen for 8,000 tons of gold held in public trust, that gap is not a conspiracy theory. That is an accountability question that has been asked by sitting members of Congress, by credentialed economists, and by former government officials. And it has never been answered satisfactorily. I am recording this right now from Chicago, and I want you to comment what day and date you are watching from, because this is a story with a long history, and I want to understand when people are finding it. And real quick, if you value this kind of no-drama breakdown that separates documented facts from political narratives, do me a favor. Subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here is the claim making the rounds. The U.S. gold at Fort Knox and the New York Fed has never been properly audited. The gold might not be there. It might have been leased out, swapped, or hypothecated. And on the surface, for people who have not looked into the actual documentation, it sounds like internet speculation. But when you trace the actual audit history, the actual congressional testimony, and the actual responses from the Treasury and the Fed, when this has been formally questioned, you realize the picture is more complicated than either the conspiracy version or the official dismissal version. Some of what the skeptics are saying is documented and verifiable. Some of it is extrapolated further than the evidence supports. And the part that is documented and verifiable is enough to justify a legitimate question about why a full independent audit has not been conducted. So I am going to break down three things. First, what the actual audit history of U.S. gold reserves shows, what was done, when it was done, and what the procedures actually involved. Second, what the specific concerns are about gold leasing and hypothecation, what the evidence shows, and where the evidence ends and the speculation begins. And third, what the audit question means for gold prices and gold as a reserve asset, regardless of what the ultimate answer turns out to be. So let's start with what we can verify. The United States officially holds approximately 8,100 tons of gold, the largest official gold reserve in the world. This gold is held primarily at Fort Knox, Kentucky, with smaller amounts at the U.S. Mint facilities in Denver and Philadelphia, and at the Federal Reserve Bank of New York, where foreign central banks also hold gold in custody. The last time Fort Knox gold was physically shown to the public or to outside observers was in 1974 when a congressional delegation and members of the press were given a tour. That is the most recent instance of anyone outside the Treasury Department physically seeing any meaningful portion of the gold held there. Since then, the Treasury has conducted what it calls audits. But those audits have been performed by the Treasury's own Office of Inspector General using Treasury employees, not by independent third parties. The procedures involve checking a sample of bars against a list of bar numbers in a register. They do not involve independently assaying every bar to verify gold content. They do not involve counting every bar against an independent tally. They involve reconciling internal records. Here is the clean way to think about what is missing. If you had $100 billion in a bank account and someone said, "We have audited it," you would ask, who did the audit? If the answer was the bank's own employees checked their own records, you would want an independent third party to confirm. That is not conspiracy thinking. That is standard fiduciary practice. The audit question about U.S. gold is not, are you hiding something? It is, why has the audit not been conducted to the same standard that would be required for any other asset of comparable national significance? Now let's talk about gold leasing, because this is where the more contested territory begins. Central bank gold leasing is a real and documented practice. Central banks lend gold to commercial banks, typically bullion banks, who use that gold for various financial operations and pay the central bank a small lease rate in return. The gold technically stays on the central bank's balance sheet as an asset even while it has been physically moved and is being used by the borrowing bank. This is legal. It is standard practice. And it is documented in financial statements if you know where to look. The International Monetary Fund changed its accounting standards in the late 1990s to require central banks to disclose gold loans separately from physical gold held. Not all central banks complied fully, and not all disclosures are transparent enough to understand the full extent of leasing. The specific question about U.S. gold is whether any portion of the Treasury's 8,000 tons has been leased out, and if so, how much and to whom. The Treasury's official position is that it does not lease gold. But the Federal Reserve Bank of New York, which holds a portion of U.S. gold and also holds foreign central bank gold in custody, has been less than fully transparent about the structure of its gold custodial and lending operations. And the gap between what is documented and what is disclosed is what keeps the question alive. Here is a question for you. If the U.S. government conducted a full independent audit of Fort Knox and New York Fed gold tomorrow, conducted by a Big Four accounting firm with full physical access and public reporting of results, do you think it would settle the question permanently, or do you think it would raise new questions? Drop that in the comments, because the answer tells you something about how you think about institutional credibility. Now here is the skeptical alternative to the skeptical position, which is me being skeptical of the skeptics. Could the 8,000 tons be fully intact, fully unencumbered, and fully available exactly as the Treasury claims? Yes, absolutely. The logistical challenge of removing or secretly disposing of 8,000 tons of gold is genuinely enormous. Gold is heavy. It is physical. Moving it leaves records. The number of people who would have had to be involved in any large-scale irregularity is large enough that maintaining secrecy over decades strains credulity. And the Treasury and Fed have strong institutional incentives to maintain the integrity of the reserve, not as a favor to the public, but because the dollar's credibility as a global reserve currency is partly underwritten by the perception that the U.S. has substantial gold backing. Here is where that defense falls short. The argument that it would be logistically difficult to misrepresent the gold does not replace the argument that it should be independently verified. Difficulty is not the same as impossibility. And more importantly, the value of an independent audit is not just discovering problems. It is providing confidence that there are no problems. The refusal to conduct one, or the consistent deflection when the question is raised formally, undermines the confidence it would otherwise generate. And I am going to say something that might annoy both sides. I am not telling you the gold is missing. I am telling you that the audit that would prove it is not missing has not been conducted to a standard that settles the question. Those are different things. And the difference matters for how you think about gold as an asset relative to dollar-denominated assets. If there is even a non-trivial probability that official gold holdings are materially different from what is claimed, that is a risk factor for the dollar's perceived backing. It does not mean the dollar collapses. It means there is an unquantified uncertainty sitting beneath the foundation of the global reserve currency. And unquantified uncertainties have a way of becoming very suddenly quantified when trust breaks down. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. Nothing changes. The audit question stays unresolved. The gold stays officially at 8,000 tons. No independent verification happens. The market treats the official figure as accurate by default because the alternative is too complicated to contemplate. Gold prices continue being driven by monetary and industrial factors, not by questions about official holdings. The audit question remains a niche concern debated in alternative finance circles without mainstream market impact. That is the base case, and it has been the base case for decades. Path 2. The audit question breaks into mainstream discourse in a meaningful way. A congressional investigation with actual subpoena power opens a formal inquiry, or a foreign central bank that holds gold at the New York Fed demands a physical audit of their holdings. And the results create questions about what else is in the vault, or a whistleblower, or a geopolitical event that forces disclosure. Any of those scenarios puts the question on the front page and creates uncertainty that markets have to price. Gold surges not because the gold is confirmed missing, but because the uncertainty is suddenly impossible to ignore. That is the tail risk. It is low probability but extremely high impact. And understanding it is part of understanding what you own when you own gold versus what you own when you own a dollar-denominated claim on gold. Here is what to watch. First, watch congressional activity around Federal Reserve audit legislation. Bills requiring Fed audits come up periodically, and their progress tells you whether political will for transparency is growing. Second, watch whether any foreign central bank publicly requests a physical audit of their New York Fed holdings. Germany's repatriation of their gold from the New York Fed several years ago was done quietly, but it was done. If other countries follow and the process creates friction or delays, that is informative. Third, watch gold lease rate data. If lease rates spike, it suggests demand to borrow physical gold is elevated, which could indicate that claimed physical inventories are less available than balance sheets suggest. Fourth, watch the tone of official responses when the audit question is raised. Confident institutions invite scrutiny. Defensive institutions deflect it. The tone of the deflection is data. So what do you actually do with this information? Here is a simple action plan. No drama. Step 1. Own physical gold that you control directly. Not a certificate. Not an allocated account at a custodian you cannot audit. Physical gold in your possession or in a vault where you have verified rights is the answer to every question about counterparty integrity. Step 2. If you hold gold through financial products, understand the custodial chain. Who holds the gold backing your ECF or allocated account? Where is it vaulted? Has it been independently audited? Those questions have answers if you look for them, and the answers should inform your confidence in the instrument. Step 3. Treat the audit question as a risk factor to understand and monitor, not as a confirmed catastrophe to panic about. The most rational response to unresolved uncertainty is appropriate hedging, not all-or-nothing positioning. Step 4. If you are building long-term gold exposure, physical possession is the cleanest version of the thesis because it eliminates all the counterparty and custodial questions that the audit story raises. Now here are my questions for you. Do you think the U.S. will ever conduct a full independent audit of Fort Knox that would satisfy an institutional standard of evidence? And does the audit question affect how you hold gold, whether you choose physical over paper? Drop your answer below and remember to include what day and date you are watching from. Subscribe and comment FinTalk OG so I know you want updates if any audit legislation or foreign repatriation news moves this story forward. And share this with someone who owns a gold ETF and has never thought about who is actually holding the gold underneath it. All right, keep your head clear, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.